Hi, my name is Ilya Zlotnik, advisor and partner with Vivaldi Capital Management, and welcome to a conversation on private credit with Robert O'Hara, a senior analyst with First Trust Capital Management, the research arm of Vivaldi Capital Management. Robert, thanks for joining us today.
Yeah, thanks for having me.
Great. Uh, this is a conversation I've been looking forward to. Private credit is a space that really I got initially introduced to in 2014 when I joined Vivaldi Capital Management. It's been an area of interest really since then, but has, I think, become more interesting as of late. The opportunity set has definitely increased. So we'll definitely spend time talking about all things private credit. But before we do, I would be interested in hearing a bit more about your background, what got you into the asset management business, and eventually to Vivaldi and First Trust.
Yeah, absolutely. I got started in the financial services industry back in 2016 with a few internships. I worked at Citigroup on the trading floor, rotated across credit derivatives trading, commodities trading. Quickly realized I did not want to be a market maker, was much more interested in a longer term time frame for investing. Ended up taking a job to go work for a multifamily office, RIA in the Southeast, where I focused predominantly on high yield credit research, trading, and portfolio management for a few SMA portfolios. Was really interested in credit and saw a very fast growing area of the market for credit in the private markets. Began doing some research on RIAs that were excelling in this area and found Vivaldi, saw that they were hiring a research analyst in the area. Always loved Chicago, so it was an excuse to move up here, and been here for a couple years now, again, focusing predominantly on private credit and structured credit.
Our work in the private credit space has definitely become a lot more robust and widespread over the past couple of years. So that's very nice for me as an advisor because it gives me a lot more opportunities in building client portfolios. Private credit is a very broad space. Maybe we could start off with what is private credit?
Yeah, it's an industry that's matured a lot, to your point, over the past couple of years. I think when you think about private credit at the highest level, it's financing or borrowing that occurs outside of the traditional banking system. So when most people think about private credit today, they may think about the direct lending space, where instead of going to a bank for an LBO financing or a sponsor-backed business that would like credit, instead of seeking that out through a syndicated market that would be run by a bank, they pursue that through non-traditional lenders. The same can be said for various different areas of the private credit ecosystem. They essentially replicate what was traditionally financing that occurred through traditional lenders, now replicated through private parties.
And why? And that's one of the things that we'll touch on today as to why the private credit markets have become a lot more appealing than maybe many years ago. But you touched on it that banks have reduced their syndication of these types of deals. Why is that?
There's structural reasons why banks have reduced the number of capital or the amount of capital that they focus on these leverage finance divisions. There's also more temporal or transitory reasons why banks have shifted away more recently. So structurally, higher capital requirements in the wake of the global financial crisis, greater regulatory scrutiny of bank balance sheets have all contributed to banks being less willing to lend in particular areas of the market. You may look more recently at a structural reason would be certain ESG or more investor-driven constraints on what banks can lend to from an industry perspective. There's also more recent or transitory, in some sense, factors such as recent bank failures, global macroeconomic uncertainty. All of that leads to banks pulling back from the amount of lending that they would otherwise be willing to lend into the system.
Yeah, so clearly the demand's still there from the borrowers. It's just has shifted from traditional money center banks and regional banks to the private lenders that we traffic in.
Right. And there's a lot of different reasons why a borrower may pursue a bank route versus a private credit route, and we can get into that. But the highest level, the bank syndicated route for larger borrowers will always be a strong option because it will be generally a little bit cheaper than what you'll see in private markets. There's disadvantages too, slower to execute, more onerous roadshow process and legal documentation. Whereas in private credit, speed of execution, certainty of execution comes at a price. And it certainly translates into a higher cost of capital, albeit the trade-offs can be beneficial for some borrowers.
Yeah, as I think about it, banks are oftentimes very bureaucratic, and the larger they are, the more red tape there is. But with a lot of the groups that we work with, they're very entrepreneurial, and they can make decisions very quickly and smart decisions.
Yeah, that's a good way of putting it. And the banks still do a very good job at lending to select areas of the market. Especially within leverage finance desks, again, at the larger end of the lending space where private credit's more recently begun to compete with the broadly syndicated loan market and other bank-run financing options. That end of the market is much more competitive. So you'd see more price competition as there's more options available for borrowers at that end of the market.
So you talked a little bit about direct lending. We started off talking about what is private credit. You mentioned direct lending. That's a big space. What other areas do we like right now, or just what other areas within private credit are worth talking about?
Yeah, absolutely. So we focused a lot of our time, both at Vivaldi Capital Management, at First Trust as well, on asset-based lending, more opportunistic lending mandates where there's flexibility to go to different portions of the capital structure based on what pricing dynamics look like at any given moment. Mandates that have the ability to both invest in private credit and liquid credit on the basis of relative value decisions in those markets. Specific to private credit, other areas that we've explored as a firm but haven't necessarily invested in include venture debt, more specialty finance-based lending, structured credit, especially structured credit mandates that may be more esoteric, either in the collateral or the structure themselves. So there's a very diverse set of options within private credit. And again, I think the best way of understanding it is whatever traditional financing options you may think historically available at a bank, those financing options very likely are offered in the private ecosystem as well.
It is remarkable because I've spent so much time in this space, not necessarily as the kind of the work that you do, but maybe on the second level, to see just how complex and diverse the space really is, and how many lending options and how much creativity goes into this over time. So private credit over the past couple of years, maybe even the past 10 to 12 years since the great financial crisis, has become more interesting because traditional lenders have backed out. The other thing that's really worth noting is interest rates. We went through a very long time with 0% interest rates. Now we have SOFRs at 5 or 6%. Let's talk about how that has impacted the private credit markets.
From an investor's perspective, this being a spread product that's floating rate in nature, you're going to see higher income. So I think that's the first implication for most investors out there that are thinking, how do higher rates affect me? As an investor, private credit especially, is nearly all income driven. Income, fees, but predominantly income driven, contractually. So if base rates rise, you're going to see a higher return target for folks who are interested in investing in the space. The second order implication are what do higher interest rates mean for credit performance and portfolio allocations? And how should I think about investing at a time when base rates are not 0 but 5.5? And I think that's something we could spend more time on. There's a lot of different areas of private credit, as we've discussed. There's a lot of different borrower profiles for someone who would pursue a private credit transaction. And there's implications for those businesses due to higher interest rates. Just to walk through a few, higher interest rates, all else equal, reduce the value of long-dated cash flows. That's simple as saying as rates go up, bond prices go down. The same works for businesses that have long-dated terminal values as a large portion of their cash flows. So venture-backed businesses, firms that aren't necessarily profitable today, but have a significant portion of their valuation derived from the future. as interest rates rise, you'll see valuations there fundamentally correct, all else equal. For businesses that lend or lenders who make loans to these borrowers on the basis of their overall value, what were conservative LTV assumptions in some areas, loan to value assumptions in some areas, as valuations adjust, those loan to values creep higher. And they may creep high enough that the financing options for an exit, a refinance, or a business sale could challenge the principal that was lent against those or lent to those borrowers. The other implication would be coverage. Lower margin businesses or businesses that are highly levered. As interest rates rise on floating rate debt, the cost to finance or the cost to carry that debt burden elevates tremendously, especially as we've seen a rather rapid increase in base rates. So I think you're seeing a lot of businesses that have liquidity issues. They're not able to generate the cash flow they need to meet that interest burden, or they're seeing structural issues with their margin profile, which may prohibit future lending. So there's a lot of areas I think that you could pull on to find the implications for higher rates in private credit.
Yeah. Well, to me, that means that with higher rates, there's been certain areas of private credit that have had tailwinds, where it's more interesting to invest in those spaces. And then, as you mentioned, there's certain areas with headwinds where economically it just doesn't make sense to lend to these companies because the return on their equity is lower than what you're financing their debt with. But because, what I like about, the seat that I'm in is we're not pigeonholed to one area. We're not pigeonholed to doing direct lending to sponsor-backed businesses because it's not really that economical right now. There's other areas that we can go into. So what are some areas that we like that have had significant tailwinds from rising rates?
I think what we've focused on most as a firm, and what we've heard from the managers that we invest alongside as well, is that the up in quality narrative is consistent across our manager footprint, which is good to see from an underwriting perspective, because that's certainly what we would expect in a market like this, where if you have a return target and all of a sudden your base rates go up 5.5%, you don't necessarily need to take as much risk in order to earn the same level of return. You're able to lend to higher quality businesses with higher quality assets, higher quality ownership groups, with better structures, better terms. So what we've done with discretionary dollars and what we've done alongside managers and seen them execute on as well is predominantly up in quality within all areas of private credit that we've been focusing on. So within structured credit, earlier this year, you saw certain rated tranches of CLOs and other structured credit transactions or securitizations dislocate as asset management dollars were less prevalent for that particular portion of the risk stack. We've always been strong investors in residual or equity tranches of some securitizations where we feel there's a repeatable edge. But when our return target can easily be met by a rated tranche that has more credit enhancement, more protection, a better downside protection profile, we've taken advantage of that on a discretionary basis. And then across our manager footprint, again, it would be as simple as saying they have looked at loans that they could have made at a spread of SOFR plus 700 or 800 with a floor at 1 or 2% a year ago or 2 years ago. And now if they made that same loan today, they would obviously be at 4 or 5% higher from just the base rate movement. So they can sacrifice some spread by lending to higher quality businesses, higher quality assets, better sponsorship groups, and earn the same rate of return. And they can do it in unique ways that protect us should interest rates fall, by implementing higher SOFR floors or higher base rate floors should the Federal Reserve end up cutting rates.
Sounds like there's a lot of creativity out there. So that's structured credit. One area that I've been spending a lot of time with my clients on, especially those clients that want current income, has been asset-backed lending.
Yeah.
Maybe we spend a little bit of time talking about the opportunity set there, and maybe even the group that we work with and why we like them so much.
Yeah, so within the asset-backed lending space in particular, we work with Whitehawk Capital Partners out of the Los Angeles area. We've worked with them for several years now, since their second fund vintage. We're now into the fourth fund vintage. Been a really great partner to them throughout their business. And I think we're really impressed with what they've been executing on recently within this opportunity set. We've seen them step into 3 or 4 transactions over the past few months that we've participated in on a co-investment basis, but also through fund investments, where we've seen that up in quality narrative really shine through. So Whitehawk, as the listeners may be aware, is an asset-based lender that focuses on understanding the true collateral value on a net orderly liquidation value basis of all the assets in which they have a lien against when they make a loan. They try to understand the value of that collateral package under various different economic stress scenarios. And then they'll make a loan with a certain degree of coverage, so a buffer, if you will, below what they think that baseline or trough collateral value is. So they have a high degree of certainty in recouping every dollar of principal, interest, and fees owed to them, irregardless of the outcome of the business when they make a loan. Traditionally, they've been able to earn attractive rates of return with strong risk-adjusted or strong downside protection. They've never lost a dollar of principal, fee, or interest on any of the loans they've made. And today, the profile of the borrower that they've been seeking out and lending to has improved tremendously. So as you'd imagine, the borrowers who tend to seek out this financing can vary in quality and state, but they generally are experiencing a period of capital inadequacy or structural issues with their business, or a period of transition that may cause them to lose access to more traditional forms of financing. What we've seen more recently is that there are bank syndicates that have pulled out, or a bank that had been the sole financing party for a business that chose not to re-up that facility or re-up the relationship when a maturity came due. And there weren't other traditional lenders available to that business for a multitude of reasons, whether that be that they were still growing into their capital structure, whether that be, again, they were facing a period of capital inadequacy or a period of transition in their business. But Whitehawk and a group of other private lenders have been able to step into these situations and lend to what are very well-financed, strong businesses, larger businesses that have strong asset profiles with the same or better rates of return, with the same or better structure. And all that has to do with supply-demand dynamics that we're seeing today within the market for financing. All of that has to do with the levers that you can pull as a private credit lender today.
Yeah, I find it interesting that they're getting the same returns, they're taking on less risk, and we are obviously in a very uncertain environment, but historically, when rates were lower, to get the returns that they did without any losses, they had to lend to troubled industries. So they have, regardless of how great the environment is, there's always going to be areas that are experiencing issues. For example, oil and gas, they lent to for many years experiencing issues. They lent to retail, obviously that experienced issues. So it makes me feel comfortable when allocating client dollars to that space. And the fact that a lot of my clients need income, they pay current income. So I like that. One thing that I wanted to talk to you about, you mentioned, is co-investments. We, as a firm, have been predominantly fund investors, but because of our relationships with these groups and the amount that we invest, we've been able to be in a really nice position to get access to individual deal flow. So maybe talk about that business for a moment and the benefits to clients to be part of that program.
Certainly. I think it's a great competitive advantage for working with Vivaldi. I would say, just to start, we'll always be fund investors first and foremost, as you mentioned. being a fund investor, being a strong and large participant in primary funds is what begets the ability to be a partner on a co-investment basis within private credit. So you don't get one without the other. But the advantages of being able to access investments on a co-investment basis within private credit are that they're much more fee advantaged. So we have various different methods of accessing that co-investment flow across the accreditation and liquidity spectrum. For private clients, there's abilities to access it on a much more direct basis for accredited, and smaller clients, there's the ability to access it on a more diversified basis. But what you'll see across the access points is a lower cost from a fee perspective, both management fee and incentive fee, than you would see within the fund structure. So I think investing with primary fund commitments predominantly, but actively working to lower your fee burden through co-investing can allow you for a diversified portfolio to gain access to fundamentally the same return profile or potentially stronger return profile if we do our jobs, and at a lower fee burden. So I think that value proposition should speak for itself in that sense. I would say that just fees in the industry that we pay for private credit, we don't pay management fees and we don't pay incentive fees on any of the private credit co-investing.
Sounds like we don't pay any fees.
Huh?
Sounds like we don't pay any fees.
We do at times pay a half point of origination
Okay.
or a point of an origination fee.
But that's so insignificant in the grand scheme of things.
And that's also what the largest private credit lenders would pay to do any of these transactions. So in a syndicated private credit transaction, the lead left on the transaction or the agent on the transaction has the ability to syndicate the loan. They often would take a half point or a point if they were syndicating it to us or if they were syndicating it to the largest asset management firms. So that's still a very competitive fee structure.
Yeah, and because we get so much lead flow, I think we mitigate one of the biggest risks, which is concentration risk.
Certainly.
And we're able to build diversified portfolios for clients and mitigate that. I guess I'll end it on this note. Any thoughts on the future of private credit, where you see it heading?
Yeah, I think that when you look at the way the regulators have approached the traditional financing system, whether that be through more aggressive capital requirements or just more stringent oversight of banks generally, I think that you'll see more and more adoption within the private credit ecosystem. I think you'll see it seep into areas that it may not currently exist, become larger in areas that it already does exist. I would expect the opportunity set to continue to grow and enhance. With that, ultimately, what happens to the asset class? Maybe 5-10 years from now, it becomes priced much more competitively. Maybe it becomes more standardized. But at the moment, in this current point in time, it's a very attractive opportunity.
Yeah. Well, we're in a good seat where we can bob and weave. So if things change,
Yeah.
we'll change with it.
Yeah.
All right. Well, thanks for your time, Robert.
Thank you. Yeah.
We'll talk to you soon.